This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, this is Radio Free Wall Street for Tuesday, December 2nd, 2014. And this program is being recorded at 4:45 p.m. New York time. I'm Lee Adler. Well, the market closed up 12.5 points today. I had written last night in the Wall Street Examiner Professional Edition market update that if the market didn't firm up, then the odds of reaching the 13-week cycle projection of 2140 or so would be radically diminished. Well, here we have the market firming up, so there's still a good shot of reaching that projection in spite of the fact that we've seen some intermediate sell signals in recent days. The market may have one last gasp rally, a blow-off going into the end of the year that approaches those levels. So we'll keep an eye on the technicals every night in the professional edition. Hope you join me there. Today I want to talk a little bit about the issue again of whether the Fed can really raise interest rates. There's been a lot of talk about when they're going to do it, and Stanley Fischer was talking about it again today, and the pundits are all speculating that sometime by the middle of 2015 the Fed's going to raise rates. So I'm going to look at that idea. And I'm also going to look at the supply and demand analysis of oil that I did yesterday in the Wall Street Examiner on the free side. That article is still posted on the front page, and we'll talk about the issue of why the price of oil is finally declining and why that could be a negative situation. Now, about the Fed and the idea of interest rates being increased. The way I look at it, when you have too much of something, the only way to increase its price is to reduce the supply. Professional economists who follow the Fed and the Fed heads themselves seem to think that the Fed merely needs to make a pronouncement that interest rates go up and that interest rates will go up. I think we're probably getting to the stage where the Fed is going to want to increase rates. I think the economy is heating up. Certainly the lower oil prices may stimulate a little more consumer spending in addition to paying down debt. But all the signs from the withholding tax collections point to the economy heating up. The trend seems to continue in that direction. So I think it's reasonable to wonder when the Fed's going to increase rates. But again, if you have too much of something, the only way to get the price up is to reduce the supply. Now, the Fed is playing some games with these new tools that it's playing with that it claims will give it control over rates. And the two primary tools that we've discussed before are the term deposit facility and the reverse repos. Now, the term deposit facility, they take in funds from the member banks by auctioning these term deposits, these 7-day term deposits. They're like CDs every Monday, and at a limit of $20 billion per customer. They're now up to $400 billion in funding that they've taken in as of the Monday auction. $400 billion. Now, part of the reason is that they raised the interest rate to 30 basis points. Now, this is money that was already sitting in deposit accounts at the Fed. So these banks really didn't have to do anything. It's money they're not going to do anything with. It's excess, $2.7 trillion in excess. So by handing it to a different account at the Fed, they're collecting interest, 30 basis points on over $400 billion now. At the same time, the Fed is now offering, in addition to its overnight reverse repos, which are limited at $300 billion, another reverse repo program of term repos of, I believe, 30 days. They're going to start that on Monday, offering $50 billion in reverse repos. Those will be offered to not just the primary dealers, but also to banks and money market funds. Now, in theory, this reduces excess reserves and it will tighten the money markets. But in practice, to the banks, it's all cash. And in fact, the Fed has even changed the rules on the term deposits that the banks can now use them as collateral. So effectively, it's the same as cash to the banks. The reverse repos, whether they're overnight or 30 days, it's all excess. Pretty much the same as cash. They can be repoed as well. So there's really no change in the amount of cash in the system, even though the Fed says these are no longer excess reserves. To the banks, it's all the same. They're going to compete with one another to get funds out into the marketplace so that they can earn interest on them. Now, their cost of funds are actually going to be reduced. The $600 billion that they're going to move into different accounts at the Fed instead of holding them in deposit accounts, that's going to be additional income to them, reducing their costs. Now, they're going to have the same amount of excess cash. Their costs of holding that cash are going to be even lower. So what are they going to do? They're going to compete more aggressively in the marketplace to get these funds into the hands of retail borrowers. So that means that rates might even come down. So the Fed, I think they're playing games with us. I can't believe that they don't see the potential that this isn't going to work at all and maybe even counterproductive. Either that or there's just something about this that I don't understand. And that could well be the case. I'm not very good in finance and understanding these complex ideas that the Fed comes up with. So if you can explain it to me, send me a note in our feedback system and maybe I'll gain an understanding of how by lowering the cost of funds and keeping the same amount of excess supply out there, the Fed is going to raise interest rates. It seems insane to me. The other thing is, let's look at the reality. The Fed has now taken in, or is about to take in, a total of $600 billion in these funds. Now, that is supposedly reducing the excess reserves. You would think that that would have some minimal impact on money market rates. But when you look at the 4-week T-bill, still 3 basis points, the same as it's been. The 13-week bill, even less, 2.5 basis points, same as it's been. There's been no change in Treasury rates. How about money market rates? I looked at commercial paper rates, 7-day commercial paper, financial and non-financial commercial paper, high quality. Oh boy, moved up 2 basis points this week from 8 to 10. The Fed is paying them 30 basis points and the market is only paying 8 to 10. Now, and that 2 basis point move may be an end of month factor, as we saw the same thing last month and the month before. So it appears that these Fed experimental operations, even though they're becoming quite substantial in size, it appears that they're having absolutely no impact on the reality in the marketplace. Rates are still virtually zero. So now let's take a look at that oil supply and demand chart and see if we can figure out what's going to happen looking at that. This chart is from the article that I wrote on Monday on why the price of oil has finally begun to decline and what that could imply for the economy, the world economy, the U.S. economy. This is a busy chart, but there's a lot of information here. So let's go over it. Starting back in 2007, if you were around at the time, you remember that we had this tremendous rise in oil prices, the price scales over here on this side, going from the $65, $70 range all the way up to about $136 a barrel. Now, that was in spite of the fact that supply was outstripping demand by about 2 million barrels a day. So that was quite a speculative blow off, quite a bubble in oil at that point. And that persisted even beyond the crash of the stock market, the beginning of the recession. For some reason, the speculators continued to pile into oil as they speculated that the Fed and the other central banks around the world were going to print money. But eventually, the oversupply took its toll, and we got an outright crash in oil prices in 2008, dropping down to the $45, $50 a barrel range. At that point, the Fed panicked. All of the markets in the world were collapsing. The Fed panicked. It started QE in November of 2008 with a limited amount of MBS and agency purchases, and then it moved into outright Treasury purchases in March of 2009. Once the Fed started to print, once the Fed started its various rounds of quantitative easing, oil prices began to rise as speculators sought money substitutes. They were getting lots and lots of free money from the banks. The primary dealers in particular were getting direct cash injections from the Fed. Of course, the primary dealers trade everything. Most assuredly, they trade futures in the futures market. So Goldman Sachs and all the other big boys were in there buying oil contracts, driving the price up into the 80s in 2010. Now, a couple of times the Fed paused QE, and we saw the price of oil moderate. And then we had QE2, and the price of oil took off again, as once again these traders and the leveraged speculating community put on this oil trade, driving prices from the $75 a barrel range up to about 107. Fed pauses again. They paused between QE2 and QE3. They stopped buying treasuries outright. They were doing the twist, but keeping the level of their balance sheet the same, so the primary dealers weren't really getting cashed out to any great extent. So prices sold off again. It came down very substantially from about 107 to about 86. And then at the end of 2012, the Fed begins QE3 here. And we saw prices gradually increase, but at a much weaker rate than in the previous advances. Finally, the speculation starts in the late 2013 that the Fed is going to begin to taper quantitative easing. They're going to begin, or at least slow their money printing. The primary dealers and those who were trading these oil futures began to pull in their horns. They did a little selling in here. We had a little more of a rally. But then it was very clear by the middle of this year, by July, that the Fed was on a straight line process of ending its money printing operations. So the smart money began to tiptoe out the door. Prices began to decline. And that as QE came to an end, as the Fed's support of the primary dealer trading operations came to an end, the price of oil crashed. Now, what is this going to entail in terms of Fed policy going forward? The Fed has been threatening to raise interest rates, and we talked about that. But what if this price collapse continues in oil? This is destroying money on the way down as margin calls go out. These margin loans get paid off. The values fall. Capital is being destroyed. And this, if it continues below this $66 level, could go down into the 50s, the 40s, and it could spread out throughout all the commodity complexes, and we could get a mass worldwide liquidation and collapse of capital and money. Now, the Fed is well aware of this, so they're probably watching this nervously. So what we have to look out for is any sign that this decline in oil prices is going to get worse, and that the Fed is going to have to reverse its policy and begin quantitative easing again. That's just one thing to keep in mind. Now, on the other hand, the economists are probably correct in saying that the decline in price of gas at the pump is going to be an economic stimulus. It's going to stimulate consumer spending. Now, the economy is already heating up. We know that from tracking the withholding tax collections, which just continue to strengthen throughout October, throughout November. We're looking at nominal year-to-year increases that are now approaching 7%, which is 4.5%, 5% growth in real terms. That's an overheating economy, and we've been talking about this. Nobody else believes it, but some of the people in the mainstream are beginning to see it. So there is a rationale on that basis for the Fed to raise rates. But if oil prices continue to collapse, the destruction of capital is going to put the Fed in a double bind. If they raise rates, that will only hasten the capital destruction. It will only increase it. So the Fed may be in a position where it won't be able to raise rates, even if theoretically it could. It won't be able to, and we're going to have to start looking at the possibility of another round of quantitative easing. So that's a little bit over the horizon, just something to put away in the back of your mind. As you know, we don't need to anticipate. We can just follow the money and watch what the Bank of Japan is doing, the ECB, along with the Fed. I'll keep you abreast of that every week in the Wall Street Examiner Fed report. It's the best way to really stay on top of these trends. Let's take a look at the chart of West Texas Intermediate crude, the futures, on a monthly bar chart going back to 2000, just to get some perspective. I've got two moving averages on this chart. The green line here is the 15-year moving average, and the red line is the 20-year moving average. And as you can see, we broke the 15-year moving average back here when we had that enormous crash in 2008. We did not break the 15-year moving average. It basically was the floor. Now we've broken the 15-year, come down to the 20, which held the sell-off in 2002. So we would expect to get some kind of a bounce here, perhaps back up into the $80 area, although it seems kind of far-fetched now. One of the things that caught my eye was when you compare the open interest today at about 1.5 million contracts, it has slipped from nearly 2 million, and it's back to about where it was in 2007. But look at the large spec long position here. We're up to about 253,000 contracts, which is half of what it was a few weeks ago. There's been a lot of carnage in the long futures, in the large specs, but it's still way above where it peaked in 2007. And that would indicate that there is still potential for this to come down significantly before we finally get a bottom on this monthly chart. If you want to do a measure across these lows here at about $78 and measured to the high of about 108, that's $30. So if you subtract that from 78, that would indicate a price objective of approximately $48 to $50 on that basis. But first, I think we get a little bounce from in here. So that'll do it for today. We'll get together again next Tuesday. That's Tuesday, December 9th. Until then, trade sane. Have a great week. I'll see you next Tuesday.